So Nigeria's central bank governor, Godwin Emefiele, today speaks far more on key issues than the interest rate parameters that was left unchanged in the monetary policy communique and the following clarifications, or what to call the Q&A, by the governor to dwell far more on credit growth, exchange rate, export remittances, and what he calls the synchronized efforts of both the fiscal and monetary policies at achieving growth and the lifting of the economy out of the pandemic in this recession. Yeah, and it came down very hard on export remittances. Listen.
What we are saying is that going forward, we will give a lot more support to export sector financing at concessionary rates so that these people and companies can generate export proceeds that would come to fund our obligations in the investors and exporters window. That's what we're saying. And that we are going to ensure that if you are an exporter, you must complete the NXP form. Because if you want to import into Nigeria today, tangible item, you fill Form M. You want to pay for intangible item, you fill Form A. By our regulation, I did not make that regulation. You want to export, you must fill NXP. We will no longer tolerate any situations where people want to conduct export activities without filling NXPs. You must complete your NXPs. We have held several engagements with the Nigerian Customs. We have held several engagements with the shipping lines, and they have committed that no export will be done without completing NXPs. Because NXPs is the only way we can regulate the volume of export activities taking place in the country.
Now let's drill down more into the monetary policy meeting and a whole lot more as we turn to Dr. Hassan Mahmud, the director in charge of monetary policy at the Central Bank of Nigeria. Good evening to you, sir, and we thank you for coming on the show.
Thank you for having me, Boason.
We appreciate your time. It's been a very busy day, so we really understand you're making it here. Let's start this three-part conversation this way. What were the key points of these two-day monetary policy deliberations and the considerations?
Okay, thank you very much. The Monetary Policy Committee were confronted with three big issues. Consistently, we have the recession going on, output growth in the negative territories. We have the rising inflation, which is the core mandate of the central bank to bring inflation down and make prices stable, both monetary and price stability mandate. And the third part of it is the exchange rate lingering problem that we have, particularly in terms of the supply or liquidity of exchange rate in the market, given the demand pressure. So the choices are between driving growth, which was the core decision of the MPC at the previous MPC meeting, because that was when we just dashed into the recession with a 6.1% contraction. However, by the third quarter of 2020, we saw a leap in that, or a reduction in the contraction to 3.6%, which quarter on quarter was like a 12% growth. The expectations in the outlook that the governor read at the communique were that given the stimulus packages, given the interventions, given that even we had a second wave of COVID-19 in the global scene, the optimism that growth will pick up faster in 2014 is a bit muted. And I mean, in the fourth quarter of 2020 is a bit muted. However, if the policy measures, the expansionary policy measures, the fiscal stimulus are to key into these growth expectations, then we expect further contraction or further moderation of the contraction in Q4. So the choice is face the inflation numbers, which is already at 15.75, rising for the last 15 consecutive months. However, the MPC members were also conscious of the fact that the monetary phenomenon, or the monetary component, or the monetary drivers of inflation is minimal. They are more of structural issues, particularly from the supply side. It's supposed to be stimulating output from the supply side, meaning production, so that as goods become available and accessible in the market, then you see prices going down. That is if there's a commensurate effective demand to pick up those inventories in the market. So while we are looking at the supply side, they're also looking at the income side. Don't forget that the inflation numbers are going to wipe out the welfare effect of the income gain if the inflation numbers are not, if the rising inflation is not tamed. So the choice is between looking at still getting us out of recession, which is very, very critical, because if you look at it, even the recession or the output contraction is also impacting on an inflation because it's a supply side shock. So the choice is looking at these two and solving them simultaneously.
Dr. Mahmud.
So the committee was confronted with this. Yes, go ahead.
Dr. Mahmud, just a quick one, respectfully, let me cut in here. When you hold a first in the year monetary policy meeting, most likely you're dealing with backward-looking set of data and development, isn't it?
Yes.
For the previous year. So if you look at the monetary policy and all that happened in 2020, what were the chief concerns for the committee and the rest of you around the table?
Well, we entered 2020 with a positive growth, 1.98, I think. And the contraction and then the COVID came in advanced economies in January. We started getting the real impact here, I think, late February, early March. So the close down commenced effectively in March. So the second quarter GDP dipped significantly, sharp dip, 6.1, like I said. However, so every other thing came on board, the fiscal, the monetary. There were proactive measures to revive the economy, to minimize the recession, because you can't compare this to the previous crisis. This is a shock that came in and the economy collapsed just in one quarter. The 2015-2016 crisis, the economy was going down with 0.5, 1% contraction. This was 6% in one quarter. So immediately there are proactive stimulus measures, expansionary monetary policy, expansionary fiscal policies, borrowing, public debt was rising up, so easing up the economy so that economic activities can pick up immediately, including releasing the lockdown, making economies to open gradually while taking caution with the COVID-19 protocols. So the second quarter, we'll start seeing the pickup of those policy measures that we're taking, and we saw quarter-on-quarter a growth of about 12%. If we're able to maintain that growth, even if it's not 12, even if it's 10%, then the numbers, the end number for the fourth quarter will be in the margin of 0.5 to 1% if there's any contraction or a very minimal positive pullout from that. But the projections are that given these developments and the expectations that we see for 2021, particularly first and second quarter, we expect confidently to enter, or cautiously confidently to enter first quarter of 2021 on a positive footing.
So do you think that some of those risk factors of 2020, were they really mitigated in 2020? And what was the outcome if you put everything together for 2020 for the central bank? You did an interest rate cut, by the way, during the year.
Yeah. I think what is important is to know is the nature of this crisis. And it's important that we situate the policy measures to the crisis that is on ground. The shock that came in is a global phenomenon. It's all economies in the world, except for China and one or two other economies in the world, all economies went into recession. So it was a global phenomenon. And it was not caused by like financial crisis or economic crisis. It was a health disaster. And the implication was the policy measures taken to curtail the COVID-19 was that everything must stop. People must stay at home. Businesses cannot produce.
Dr. Mahmud, let's continue this conversation after the break. We have a whole lot more about the concerns of the members of the MPC about the state of the economy moving forward. Stand by, everyone. We'll be right back. Dr. Hassan Mahmud, Director in charge of monetary policy at the Central Bank of Nigeria. Thank you very much, Dr. Mahmud, for sticking by for this conversation. Let's continue from where we stopped off. What were the chief concerns of the key concerns of the members of the committee at the just concluded meeting?
Okay, thank you again. I think it's centered around two critical issues. One, the rising inflation, because like I said, in the last MPC, it was centrally around the recession. This time around, it was the rising inflation because the inflation was already at 15.75%. The second part of it was the demand pressure for FX, given that the supply side is still thinning out. Oil prices are going down, oil prices has not increased substantially, our production level has also not increased substantially. Inflows are also, dwindling, outflows are increasing, so you see that net outflow from that end of it. So, and then the demand pressure is there. The import request for FX was still very rising. So, and we had two price adjustments, if you can remember that, during the same period. So the two issues, and also there's a realization of depreciating further and having impact again on inflation. So how do we address this inflation? Not forgetting the output problem that is in there, and how do you address the FX issues in terms of how do you make the market liquid so that those that really need to import the essentials, including machineries to drive the manufacturing output that we're expecting to drive the economy, are able to have access to those funds.
One word, a few words kept cropping up all through the governor's briefing in the communique, of course, which is the kind of a report of the two-day meeting. Insecurity, yes, COVID-19 is already on the street, but it looks like almost every sentence of that report that the governor read was all about insecurity, insecurity, insecurity. So how critical is this as one of the elements in the box for the Monetary Policy Committee and the Central Bank? In terms of your various interventions, for example, you're intervening in agriculture and a few other sectors, and here is insecurity around perhaps some of the farms or some of the beneficiaries.
Yeah, the insecurity thing is central to the inflation problems we have. One, it is not just having the production, it is also important to get the produce to the market. And also there was also disruption in production anyway. So you have this supply constraints in terms of the production not meeting the domestic demand, and then secondly, this production is not getting to the market. So the scarcity in the market necessitates price increases because the demand is still there. And also don't forget that there are stimulus packages that were also going into the TCF, that was targeted credit facility that was going on, the one from the federal government, the cash stipends that were given to vulnerable people. So there was some form of income level raising and liquidity in the system, but the supply is thin there. So definitely prices will go up. So it's a supply push or cost push inflation. So the security issue was very, very critical, because even if you pump that much money to make the production, it doesn't get to the market. So the inventories are built up, they're wasted at the farms, and that will further increase the price. So, however, the monetary authorities see the security issue as an exogenous factor to the space, but there must be a collaboration with the government and any other way that the public sector can be assisted to get this security issue addressed immediately, so that at least people can also move, because it also affects trade, also affect the livelihoods of the people. So it's very, very critical in this whole game to get security apparatus functioning efficiently.
When inflation happens, Dr. Mahmud, when inflation happens like this, the folks says it's the fault of the Central Bank of Nigeria, that is your duty to fix it. Yeah,
the mandate of Central Bank of Nigeria is price and monetary stability, and that price includes inflation, interest rate, and exchange rate. But like I said, the structural component, inflation has both monetary and structural drivers. However, the proportion of the structural, particularly legacy structural issues that affect supply side, is more fundamental in this inflation trajectory we're seeing. And so the use of monetary policy tool effective, particularly a good example is because inflation is going up now, the theoretical best monetary policy tool to use, so jack up interest rate. But you and I know that jacking up interest rate at this time in the crisis, where you are looking for credit expansion, liquidity in the system, income to households and firms, will be counterproductive. So the only way we can address this effectively now is to follow this non-conventional monetary policy approach of interventions in terms of stimulus packages to the real sectors of the economy, particularly agriculture, manufacturing, and other SMEs, such that you can increase production and productivity to hit the market. So it's a structural issue. These are not short-term things that you can adjust with monetary policy tools, like you can just change, adjust exchange rate prices or money market rates or MPR. You know, the transmission from MPR to getting output growth in the short run is quite weak. So definitely it's a structural phenomenon and has to be addressed from that angle.
Well, the Monetary Policy Committee also advised the federal government not to shut down the economy because of COVID-19. This was one of the areas they want the government to focus on. How was this arrived at?
Yeah, like I said in the beginning, you know, the whole COVID-19 was a health crisis. However, it dovetailed to become an economic crisis. The economic consequences of the solutions to the health crisis was very, very devastating. And that's what made, like I said, all economies in the world to go into negative territory. However, in addressing those shocks that came from the health crisis that has impacted the economy, the jobs, millions of jobs are lost, livelihoods are lost, people lost their main source of income, the central bank or the monetary authorities must definitely, you know, look at what side of the monetary policy tools can be used to address, or what monetary policy tool can be used to address this phenomenon in the short run. However, we will also be looking at how you can propel growth to pick up in the long run.
So, the central bank governor today said that the intervention funds of the central bank at 5%, which has a deadline of repayment March this year, has been extended for another 1 year until March 2022. What impact are you expecting this to have on your output growth focus?
If you look at the developments over this crisis period, we see some level of resilience in the financial sector. Invariably, the financial sector was able to sustain, you know, the credit space by seeing expansion in credit even within this crisis period. The governor mentioned in the communique that month on month, credit increased by 772 billion naira, and in percentage, about 13.22%. That there's a need to consolidate that gain from the financial side of the economy. However, there are also signs of, you know, fragility in the financial sector too, because they are necessarily connected to the rest of the economy. So the extension, including the forbearances that were given to banks, be able to restructure existing loans for businesses that were affected by COVID-19. So the extension of this central bank facility by 10% is just to also cushion the effect of these shocks on households, firms, and businesses. Even in the statistics that were also shown, substantial part of businesses and firms and households get loans now at less than 10%.
Well, let's come back after the break. Hold that thought. We'll continue after this break. Thank you very much. Yes, we're moving to the future forward part of our conversation with Dr. Hassan Mahmud, Director in charge of monetary policy at the Central Bank of Nigeria. Dr. Mahmud, thank you so much. We appreciate your time. You were talking about the impact, the expected impact of this 5% intervention repayment fund of the Central Bank that has been moved forward to March 2022. Do you think the Central Bank, are you likely to do anything in that line across the corridor of your various interventions? What more are we expecting in 2021?
Okay, like I mentioned earlier, the 5% extended for another 1 year One is a relief or is a cushion for both the financial system, the banking sector, and including the obligors, the borrowers. And that will mean the ease at which the people that borrow will be able to pay back their funds, given the consideration that their income inflows will be limited over this crisis period. So it gives them room to be able to absorb some of these losses that are likely to crystallize. And it also enables the bank to be a lot more sound and be able to meet all its prudential and regulatory requirements, and as well as allowing the customers to be able to expand their businesses at a more liberal or more soft repayment terms. The governor has also said that in some of the facilities, they are going to be increased. Recently the TCF was increased from 150 to 300 billion. Other facilities are also going to be extended. There are interventions now going to metering. About 5 million meters are going to be provided, financed by the central bank. There's something going on in the housing sector, something still going on in the agricultural sector. Commercial agriculture is still going on. A lot of resources are targeted at the health sector, including research and education. And the governor also promised that the bank through the CACOVID, or the central bank through the CACOVID, will also support the procurement and distribution of vaccines for the COVID-19 vaccines. So these are real measures that are geared towards, one, enabling the economy to resume normal activity. And that's why the governor also re-emphasized in the meeting, while we take precaution as prescribed by the Presidential Task Force on COVID-19, there's a need not to lock down the economy 100%. And that is common to all economies in the world, because, like I mentioned earlier, that was one of the main reasons why the economic superstructure collapsed totally, because nothing was going on. But if there's no complete lockdown, and economic activities can take place, because if you don't do your business and sell, you can't pay back your loan. And we don't want the NPL numbers to go down, or the banks wipe their capital being wiped out from making provisions for lost loans. So I think the bucket of all these interventions, don't also forget that the economic sustainability plans of over 2.8 trillion is also on ground, and there's housing there, there's interventions in different sectors of the economy. So I think both fiscal and monetary have done significantly well, even though the hole there is still so big. The governor mentioned in the communique that we are just doing 4%, 4.5% of our GDP, while some countries are already doing 30%, 25%. Even South Africa here is doing over 10%. So it is important we spend ourselves out of this recession. And then thereafter, we start coming to look at the issues of public debt sustainability, central bank balance sheet, and stuff like that. But right now, globally, is get the economic restored, and then you can talk of other macroeconomic indicators that you need to put macroeconomic stability in proper space.
Dr. Mahmud, does the central bank have an exchange rate focus for 2020, and what areas are you leaning on to be able to defend the naira, to use that phrase, loosely speaking?
Okay, I think the governor also mentioned this in his communique. The problem of the exchange rate is also a supply side problem. One, even though there are demand pressures, we'll come to that, but the supply side of it, the sources of FX, of foreign exchange in Nigeria, principally was the oil price or oil revenue. That has shrunk significantly, and there are also limitations to that given the OPEC supply quota or production quota that will also limit the amount that you can produce. The price is still within the $50 range. Don't forget that was the prices were like $120, $130. It's just less than 10 years ago. And then we also saw the big crash in oil price in January. So $12, $13 a barrel. So that hit the supply source, particularly for government. Central bank does not export anything. So it's what the government earns that comes to the central bank for why central bank monetize that for government to do is public spending. The second source is export proceeds through exporting non-oil export goods. This is also affected by the COVID because productions, businesses were closed. So that side also dwindled significantly. Two options were open to the bank, which the governor also explained. One, to get other inflows, FDI, FPI, and then diaspora funding, diaspora remittances. And governor mentioned in his communique that there are different numbers of this diaspora funding that is hanging there, 20 billion, 25 billion, 22 billion. If the bank is also working towards creating those instruments that will attract those diaspora funding, including giving incentives through reducing the cost of remittances, so that this chunk of money, legitimate money, can come into the economy and supplement these other inflows from foreign, from government revenue and the export proceeds. In the central bank intervention programs, so we have the export stimulating fund that is supposed to be used for non-oil export goods, financing of those non-oil export goods, so that the inflows, the proceeds, and governor also mentioned the arbitrages that operate in that when he was talking of the MPX that exporters needs to fill, such that the proceed comes into the system and are being used for other people that also want to import, so to export. So if you get central bank funding to process your export or to produce your export, you're able to export, and you get your gains, your payments, and then you divert that to other external sources and go and be using the parallel market to do some arbitrage in terms of the prices, then governor has warned sternly that such kind of acts will be dealt with. So while we are managing the supply side, the demand side will also be managed. And the second demand solution is for people to use what we have here. There are a lot of potentials there. There are a lot of resources, including raw materials, including machineries and technology. So if we look more inward and reduce the import, if you look at our balance sheet now, the balance of payment, you see the effect of the current account in terms of the import volume. So if you can reduce that, so that pressure will reduce, and then the domestic economy will be able to also revive very quickly, because we have the market.
Dr. Hassan, to wrap up this conversation, thank you so much. My final question really is, I'm sure the central bank you've had your major meeting of the year, not the MPC, I mean within yourself, but have you discussed what's this very tenuous issue about harmonization of exchange rates in the country? If you've discussed it, what's the new direction on that this year?
It's been on the front burner since 2020, even preceding that period. And it's also important to understand that we have only two FX markets, wholesale and retail. There are other windows that were created, particularly the SME windows and other windows that were created then to make FX available to like small and medium enterprise businesses for just $20,000. However, the principal source of FX for businesses, transparent, legitimate businesses, is the I&E window. People bring in their funds there. You can go and pick your funds there and do your export and your import businesses. And that window, prices and that window has been very stable over the period. We also, I don't know what we call the parallel market, but we have the BDC market. We have the BDC market, or the BDC segment of the exchange rate market, where the transactions in that market are just to be within $20,000 for travels and other small invisible activities in the business. The informal market, which is the bank does not have statistics on that or have control over that market, is purely outside the purview of the central bank, and we don't use the activities in that market because it's an illegal market as anchor for the prices of transaction in the exchange rate market.
So would there be a harmonization of those other market rates this year? Is it a possibility?
Currently, if you look at the interbank market, the I&E window, the rates are already merging. The variance between those two rates is less than 3%. And the global standard or the global requirement is the variation between the rates in your market should not be more than, even as the IMF standard. So for that, we're within the range. However, if you look at where the bulk of the activities takes place, even the official window, or used to call official window, the rate has also ticked up to the INU window rate. So the variation and the rate at which the central bank sells to the BDC, it's also around the INU window rate, it affects rate. So technically, the convergence is already coming up. You can't have one, even all over the world. If you go to England or the US and you go to Bureau de Change or Xchange, or even in the banks, you can't get the same $1 for €2 in every bank. There are variations, but what is important is the margin. The premium, the wideness of that margin shows the inefficiency of the market or inefficiency of the rate. So long as that margin is within that acceptable band, then we can say the rates have technically converged.
Dr. Hassan Mahmud, Director of Monetary Policy at the Central Bank of Nigeria, thank you so much. We appreciate your time this evening.